Our focus right now is on earnings and on the banks. Best place to start, I think, might be JP Morgan's broad ownership here. Joe, I'm going to start with you. Record full-year earnings, record full-year revenue, investment banking revenue up 3% year over year. What was your take?
My take is there's JP Morgan and then there's the rest of the banks. And that's the story. That is the way it has been for the better part of the last 12 months. It's the reason why I own JP Morgan personally, and in the Joe T ETF, we've been underweight financials for the last year. It is so disappointing to see what the other banks are reporting relative to the strength that JP Morgan is reporting. 7 consecutive quarters of record net interest income. And there was no conversation about net interest income declining at JP Morgan like there was at Wells Fargo. Wells Fargo said net interest income could be down 9% in the coming year while Wells Fargo's expenses rise. So disappointing for all the other banks. I'm a little bit surprised at Citi. I thought the near-term momentum that Citi had, I thought, in fact, you'd see some buying demand surface. You're not seeing that. Basically, if you're stepping in and buying Citi, you're believing that CEO Jane Frazier's comments about 24 being a turnaround story, that in fact could be correct. But Bank of America trading revenue declines for fixed income, 5.8%. These other money center banks are just not delivering what JP Morgan is delivering on.
Yeah, I think you might have a Citigroup believer down there on the other end of the desk. But I'm going to talk about JP Morgan a little bit longer with Brenda. What was your take on the quarter and also the comments from Jamie Dimon, kind of on one hand saying the economy's strong, on the other hand, really spelling out a lot of geopolitical issues and macro issues?
Well, I think on Jamie Dimon's comments, it's not unlike what we've heard from him over and over again, where he's expressed concern over various components of the macro environment or geopolitical environment. But when we look at the results from the bank, we look at the results in his commentary about the consumer, they continue to be positive. I mean, one thing we also heard on the conference call is that they're seeing the consumer normalize, in their words. And, that means there's not as much excess savings there, but the consumer is still healthy. But I think that's something to keep an eye on because that's going to flow through to overall consumer spending. And we'll see if we're able to keep up with a year like we had last year, where consumers really did spend a lot on things like travel. But I think overall, we were pleased with the quarter, pleased with the commentary, but not surprising to hear Jamie Dimon's, cautious comments because we've heard that over and over again.
What did you make of JP Morgan and, in all fairness, Bank of America as well, saying, if not for that FDIC special fee, our results would have been this? Is that meaningful to you as an investor?
I think it's part of business in the current environment. It's known, and it's a function of the banking crisis that we had early last year. So I think we can move on and move forward. And so not terribly surprising, and certainly doesn't change our view of JP Morgan, although I'll say that is our only exposure to banks, is JP Morgan.
So Jim, you own JP Morgan, you also own Citigroup. Revenue miss, EPS of 84 cents, not even clear if that's comparable to estimates. In September, Jane Frazier said she's reorganizing. Now we know it's at least 20,000 layoffs, $1 billion charge related to severances. My good friend Hugh Sun from CNBC.com, litany of charges.
Yeah, but frankly, expected. And when I say expected, why do I say that? It's because the stock trades at a 40% discount to tangible book value. So the street already understands that whatever book value is, it's got to get knocked down by charges. And frankly, in that scheme of things, the size of the charges that we're talking about are actually minuscule, okay? So that if you actually got Citigroup up to tangible book value, you would see something like a 30% share appreciation from here, maybe 40%. Joe, I hear what you're saying, and I don't argue against it about JP Morgan versus everyone else. For a few months now, I've tried to recharacterize this. I don't want to say for a second that Citigroup is competing with JP Morgan. They're light years apart. I mean, you can look at the wealth management business. You can look at the investment banking business. Citigroup's a different story. It's a restructuring story. And let's face it, this is a restructuring that has been overdue by almost 25 years, going back to when Sandy Weill built this behemoth, and it got way out of hand. Jane Frazier is the first person who has actually taken a scalpel, or maybe it's a machete, to getting this bank to the right size. She's taken a lot of steps in that regard. I think she's making great progress. And for Citigroup, what you're really looking for here is where are expenses headed? They're headed down. That's in the guidance. Was the quarter great? No, the quarter was bad and had all this sort of charges. But the year ahead, you're looking at expenses coming down, and that's what investors in Citigroup want to see.
So are you buying Citigroup for the turnaround story, which evolves over the course of 2024? Or are you buying Citigroup because you believe the turnaround is something that's going to be sustainable and you could own this the way you could own JP Morgan for multiple years?
Yeah, again, I don't want to make the comparison to JP Morgan. We're just talking about light years
but just
different,
purely
right?
on a time, thinking through ownership time frame.
I do think it's sustainable, to answer your question, right? These are permanent expense cuts. Just the way by the way, some of the charges, right, were international charges because they're shutting down operations in places like Russia. In the next year and a half, they're going to spin out the Banamex operation. These are things that do take time. But once you do something like spin out the Banamex operation, you're not going to bring it back in. So it is sustainable. And the key here, Joe, the key here is tangible book value. You're trading at 60% of tangible book value. That's too low.
But if you're getting leaner as a company, is there enough revenue growth from the business?
Yes.
Just think about this 1 second. I was surprised to know this. Citigroup shuts its muni business. Citigroup shuts its distressed debt business.
Yeah.
I know you don't want to make the comparison to JP Morgan, but as an example, JP Morgan's actually investing in those businesses. So on the other side of a leaner Citi, is there enough growth engines?
Yeah, no, this is a great question. So in addition to not comparing the two, you got to know what Citigroup's focus is. It's on cash management. It's on treasury solutions for corporations. It's on security servicing. It's not on doing investment banking and advising one company over acquiring the other. And look, the muni business, and I know this from my family history, has been tough for decades. It has been tough for decades.
So it seems like the underlying question here is, do you believe in Jane Frazier's leadership? We'll have to wait and see. Citi shares in the red right now. But Jenny, I want to come over to you. Uncharacteristically quiet. I know you don't own any of these big banks, but what did you make of this kind of noisy start to earnings season? One thing I want to ask you about, Bank of America, big consumer bank, they said net interest income decreased by 5% due to higher deposit costs and lower deposit balances. What does that say to you?
So I'm thinking two things listening to this. One, the reason I was so excited to start to hear the bank's earnings is thinking about what they're going to tell us about the consumer and the health of the consumer. And it's interesting, too, because as we've been talking about the consumer, I keep thinking that there's different consumers out there, right? There's like the high-end consumer, and they're doing fine. There's lower end, like we need to be real. It's bifurcated. So that's why you see things like American Express holding up, 30-day loan delinquencies there, like really low, things like Discover much higher. And I think it's interesting listening to you all talk about JP Morgan versus Citi. I know we haven't talked much about Wells yet, but there's big differences in the customers of those banks and in the prospects of those banks. So what I'm really listening for are things like layoffs, because you know what? Layoffs, however you cut it, are kind of bad for society. They're bad for the unemployment rate. They're bad for American consumers. So I'm looking for those. I'm looking at, to your point exactly, the decrease in net interest income. Why is that happening? It's because there's weakness out there. So I think it's very insightful from a macro perspective, but then there's another broader thing too, which is how are we getting to these earnings? Because again, don't forget, we're just in fourth quarter. And so fine if they made their numbers, that means 2023's S&P earnings are kind of signed, sealed, and delivered. But what the outlook is really important. And so when we see decreases at NII, and we think, all right, well, to get to analyst expectations for 2024, we need S&P earnings to grow by about 12%. This is very insightful because what they're saying so far is like, yeah, we made earnings, but there's not so much growth ahead. And so I think that worries me a little bit as we think out to the year ahead. Can we really get that 12% growth that we need, or is it going to be less? I think that we will grow off of 2023's earnings collectively, not just banking, but I don't think we're going to get to that 12%. I think it'll be interesting to see where we end up. So I'm looking at this as much more of a macro insight than individual banks.